Hi everyone, and welcome to Bookkeeping Basics. Again, my name is Karen Noblick. I'm from Cougar Ridge Bookkeeping here in Rocky Mountain House, Alberta. So we have a lot of experience working with other small businesses, and we'd like to share some of that information with you today. Our business is a member of the Canadian Bookkeepers Association, and I am also a SAGE Premier Advisor with Sage 50 Simply Accounting Software. So what we do, we work with all types of small businesses, from small sole proprietor businesses to partnerships to limited corporations in a variety of industries. We have clients from retail markets, we have oil field related industries, we have caterers, we have dentists. So we do have a variety of experience in a variety of industries. What we try to remember is what we're there for. And what we are there for is to help business owners who have a problem finding the time to keep their accurate records and who just really don't know how to do that or how to find the help to do that. So we help them focus really on looking after their business and doing the things that they're good at while we focus on their books and their bookkeeping. But that being said, we also understand that often small businesses would like to try or to do their own bookkeeping, and therefore we offer some help along the way with that as well. And that's what this webinar is hopefully going to be able to do for you today. So we're just going to go over a few things about what we're going to cover in today's webinar. First, we're going to have a little bit of a talk about what is bookkeeping and how is that different from accounting. So you'll hear people talk about accounting, you'll hear people talking about the bookkeeping that needs to be done, and there really is quite a big difference between bookkeeping and accounting. And so we'll have a little discussion and a comparison of what those are and what the differences are. We're also going to talk about why bookkeeping is so important. You know, often business owners think the most important part of their business is just doing the business and creating sales, and that is true. But without proper bookkeeping, there's all kinds of other issues, and we'll talk about those. We'll give you some insight about the accounting jargon, so you'll hear all sorts of terms when you're talking to your accountant or your bookkeeper or your bank manager, and you may be confused as to what those items are and what they're asking. So we'll review some of those terms in accounting jargon. Then we'll have a bit of an overview of the basics of bookkeeping. So what is bookkeeping? Why is it important? And then the basics of how bookkeeping is done. Keep in mind that bookkeeping is a full college course. So it would not be possible to learn everything there is to know about bookkeeping and how to enter all the transactions in one webinar. That there is more to it than just learning a little bit in an hour. But we'll go over the basics of it to give you an idea of what is all involved in a full bookkeeping cycle. We'll talk about bank reconciliations, which is something that's done on a monthly basis. We'll then review some of the financial statements that are created from the numbers that you use in your regular bookkeeping records. And we'll also discuss some of the common errors that we see that bookkeepers tend to make in their own books. So this is a great time, because this is a webinar, to hit pause, go grab a coffee, grab a tea, something to drink or a snack, and then you can just sit back, relax, listen, and try to learn a little about the basics of bookkeeping. We understand bookkeeping is not an exciting topic, but it is very necessary. So therefore, we'll try to keep it as light as possible and just do the best that we can. Proper bookkeeping is critical to the health and the success of your business. And that is something that we always want our small business owners to keep in mind. It is critical to your success. So let's get started with what is bookkeeping. So you'll see what the definition is if you were looking in the dictionary: the activity or occupation of keeping records of the financial affairs of a business. Basically, it's just keeping track of everything that your business does financially. Anything that has to do with money needs to be recorded in your bookkeeping records. So that might include purchases you've made, sales that you've made, receipts that you've received from your customers, payments that you've paid out to your suppliers, the GST that you collect, the GST that you pay, what your payroll expenses are, how to record those, Okay, and then creating financial statements that give you an overview of how your business is doing and what the health of that business is. So that is what bookkeeping is. It's basically recording all money transactions that happen in your business. So like we said in the introduction, there's often a lot of talk about bookkeeping and accounting, or bookkeepers and accountants. And really there is quite a big difference between the two. They are not one and the same. So if we have a look at the screen, bookkeeping records the daily transactions. So every single transaction that happens in your business is recorded by either you, the bookkeeper, or your bookkeeping company that you may hire. And it's done in a consistent way. So we even say that even if you're doing it wrong, if you do it wrong in a consistent way, it's something that's easily tracked and followed. Always to remember when you're doing your records and doing your bookkeeping and recording your daily transactions, that you want to make sure that you give all of the information that you can to be able to sort of tell the story of what happened in that transaction. And so that's done on a daily basis in your bookkeeping records. Bookkeeping is very transactional. That means it's very specific to each individual transaction, and it's administrative. So it's something that's done on a regular basis. Bookkeeping maintains a balanced general ledger by recording sales, the receipts for those sales, purchases, payments that you make, GST, payroll, remittances, and more. And you'll see we've highlighted the word balanced because as we'll see as we go further on, balanced is the very important word in bookkeeping. Okay. Basically, bookkeeping is the foundation of the overall accounting process. So just like when you build a house, you want a strong foundation to build a house on top of. Same with accounting. If you don't have a strong bookkeeping foundation, the accounting part and the analysis part of your records and of your finances really is not any, it just is nothing that has any value if the actual foundation is not there. So if your bookkeeping records are not accurate, neither then will be the yearly reporting or any of the reporting that you do. So you want to be as accurate as possible when doing your bookkeeping and your daily transactions. The flip side is the accounting or the accountant's role in your business. Accounting is very subjective, which means that it involves the interpreting and the classifying, the analyzing, and the summarizing of the data that you put together in your bookkeeping records. So you would take your records to an accountant or to the person who's doing your year-end tax return, and they will summarize, they'll help you analyze, they'll have a look, an overall picture of your records to help you determine the success of your business. Accounting involves preparing correction or what we call adjusting entries. So there are certain entries at year-end that are made to maybe record depreciation or to make correction of any errors that may have been made in the bookkeeping records throughout the year. Accounting also prepares official company financial statements. So while you as a bookkeeper, or maybe your bookkeeper that you've outsourced, may provide you with financial statements periodically throughout the year, the final official financial statements are done at year-end when the accounting portion of your records is complete. Accounting means completing your income tax returns and just provides an overall yearly picture of the health of your business. Okay? Having that information at year-end with a good solid foundation of bookkeeping records and the aid of an accountant to help you analyze those records will help you determine the appropriate direction for your company in the coming year. So why is it so important? Well, we have a look at that picture there with all of the stack of unorganized paper. Quite frankly, that is quite an organized stack, really, compared to what we've often seen in our office. And I can imagine how some of you have stacks of paper in your offices, and they just grow. Ignored paper grows. Okay, and most bookkeeping in most small businesses will always start this way. It will start with a pile of paper that eventually you'll get to, and we also know that often the bookkeeping and the record keeping is one of the last things on the to-do list. But remember that in the cycle of your business, while you are trying to make good business decisions, while you are trying to perhaps apply for a loan, you're going to need to know what the numbers on those piles of paper represent. You're going to be trying to manage your cash flow. You might be wanting to hire a new employee and wondering if you can afford it. And all of those decisions are going to require financial information that you're going to have to try to extract from that pile of paper. So that's why we can't stress enough how important it is to do regular bookkeeping, keep on top of it, understand what the numbers are telling you, and you'll be better apt to make those decisions. Cleaner records will give you better information for those decisions. Also, any errors or omissions that are in your records can be found quickly and more easily corrected. If you make an error in the bookkeeping, or if there was an error on a bank statement, or there was an error in perhaps an amount that you've paid to a supplier, if you wait 9 months or a year to do your books, it's going to be very difficult to go back and fix those. So again, very important to stay on top of your bookkeeping and keep those records up to date. If you can provide your accountant at year end with up-to-date, accurate records, then they can spend their time helping you, giving you advice, making the proper corrections, doing your tax return, and being there to guide you in your decisions moving forward, rather than spending the time trying to do your books and trying to track what transactions happen throughout the year. So let's just go through some of the terms that you're often going to hear when we talk bookkeeping or accounting. They can sometimes seem a little overwhelming just because of the nature of the words, but they really just try to tell the story of what's happening in your bookkeeping and in your business. So some of the first terms are just types of accounts that you'll often hear. So for example, the first one is assets. What are assets? Assets are property that is owned by your business and it's regarded as having value. So that might be your bank accounts and the cash that you have in them. It might be equipment that you've purchased to do the business. It might be office furniture. It might be computer software. It might be the building that you own or the land that it's sitting on. Those are all considered assets. They have value for your business and they are owned by you, the business owner, or by your business itself. The second term is also an account type, and that is a liability. Where assets are the things you own, liabilities are then the amount of money that you owe. So your debts, those are your liabilities. Those are the obligations that your business has. And that might be in the form of a bank loan, maybe a credit card debt, the payroll remittances that are due to the government, to CRA, or the values that you owe to your suppliers. So your accounts payable. What do you owe to the people that you purchase your supplies from? Those are liabilities. The third term, or the third account type, is equity. And equity is found on a financial statement called the balance sheet that we'll talk about a little later. And it represents the funds that are contributed by you, the business owner, plus any retained earnings, which is the profit or the loss in prior years of your business. So the profits and the loss of your business are carried forward from year to year as retained earnings. That, along with what you add or take from your company as the business owner, is your equity. So those three terms, assets, liabilities, and equity, are words and terms that you're going to hear when you talk to your accountant, perhaps even your bank manager or your loans officer, about balance sheets. Those are all balance sheets accounts. And we will again talk about the balance sheet financial statement further down this presentation. The next couple of terms are found on a financial statement called the income statement, or sometimes referred to as the profit and loss statement. And these ones are terms that you've probably heard and recognized quite easily, and that is revenue and expenses. So revenue is the sales. It's the money that you generate from the sales that you do, from grants maybe that you receive from the government, from interest earned at the bank. Basically, it's all the money that's coming into you is your revenue. The expenses, of course, are everything that you have to pay out in order to run your business. So expenses might be telephone, might be fuel, might be repairs and maintenance, could be advertising. Those are all of the money categories that you spend in order to run your business. So the next group of terms are all regarding the types of financial statements and reports that as a business owner you may want to review on a regular basis, or that may be requested by you, from you by your bank loans officer, from your accountant. The first one is a general ledger. So the general ledger is the basically the package, or it's the book that we often call it a book, that contains all of the accounts that you are going to record your daily transactions in. And those are all accounts that relate to your assets that we've just talked about, your liabilities, the equity, the revenue, and expenses. So if you can think of the general ledger as one big book with different categories, which are your accounts, and that is where you're going to track every transaction that your business has. The trial balance is also a report or a financial statement that lists all of those accounts in the general ledger. So everything that you've put into the general ledger then is recorded in list form on a trial balance. Okay. And then we take the balances of those accounts and we put them in either the debit or the credit column, and we'll talk a little bit more about that down the road. And that just confirms that your business is in balance, as we say. So that is the trial balance. It's a list of all of your accounts and what the balance of each of those accounts is. The next financial statement that you'll often hear about is the balance sheet, and that is a snapshot of your business at a specific point in time. So a balance sheet might be as of May 31st, 2018, as of a specific day. And it shows all of your assets and your liabilities. So it will list all of your bank accounts and how much money you have in them, all of the equipment and all of the capital assets that you have as something that you own. And it will also total those all up to give you a total picture of what you own as a business. It also lists all of the liabilities. So how much do you owe in bank loans? How much do you have on credit card payments? How much do you owe the government? And the difference between the two of them. So the difference between those assets and the liabilities, the difference between the amount you own minus the amount you owe, is the equity. Okay? That is the money that's supplied by you, or the money that has come into the company through profit or out of the company through loss. Okay? And all of that is recorded on the balance sheet. It's called the balance sheet because it must balance. Your assets must equal the liabilities and the equity together. The last financial statement that you might hear of, again, is the income statement, often referred to as the profit and loss statement. And that shows the difference between the income that you've earned and the expenses that you've paid out. And this is a very important financial statement for you because it's going to show if your business has made a profit or if it's incurred a loss. Because you're going to take the revenue, subtract your expenses, and the bottom line, and you'll often hear that term, the bottom line, will show you if you've made a profit or a loss. So here's just some other general terms that you hear with accounting and bookkeeping processes. Debits and credits. Often these are confusing for people, but basically a debit records an increase in your asset or your expense account. So again, if you're thinking of your general ledger, your big book with all of the different accounts in it, if you are recording an increase to an asset or to an expense, then that becomes a debit. It's used to add cash, perhaps, to your bank account, maybe to add a new asset if you buy a new piece of equipment, or it will record the expense that you incurred. Debits also can be used to decrease a liability, such as a loan payment. So to use a debit would be to increase an asset or an expense, or to decrease a liability. Credits are the opposite, and they are used to increase a liability or a revenue account. So if your sales are increasing, then your sales are recorded in the credit column. If you are taking another bank loan that is increasing your liability, that amount is recorded in the credit column. A credit can also be used, though, to decrease an asset. So it does the opposite of what the debit does. If a debit increases an asset, the credit will decrease the asset. So a credit might decrease your bank account, for example, when you withdraw money or when you pay a bill from your bank. Other terms such as payroll expenses and liabilities, and what the difference is between those two. Payroll expenses are the employer's portion of the CPP and EI that you send to CRA. So for every amount of CPP that you take off your employee's paycheck, you as the employer must add that same amount, and that becomes your expense, your payroll expense. We're not going to get into a lot of detail today about payroll expenses or liabilities or how they're managed. We do have another webinar in the series that will explain that better, and you may want to purchase that webinar as well. But just so you know the difference between the expenses and the liabilities. The expenses are the cost of your share of the portion of the CPP and EI. The liabilities then is the total amount that you owe to the government as a remittance. And the remittance is the money that you have to pay to CRA, and that can be an income tax remittance, a GST remittance, or like we were just discussing, a payroll remittance. So a remittance is money that is paid. So those are kind of the basic terms that you'll hear on and off throughout this presentation or throughout your conversations with different people that may be requiring to see your bookkeeping records throughout your business life. So let's get on to the basics of bookkeeping. Now again, like I said earlier, it's impossible to teach bookkeeping and how to record every single transaction in one webinar. It is a little more complex than just being able to say this is how you do this and this and this, and you'd be able to know it. But it's important for you to understand what the basics of bookkeeping are, what the goal of your bookkeeping should be. So with every transaction that you enter, you always want to keep in mind that you are trying to tell the story of what happened that day. So make sure when you record a transaction into your general ledger that you always include the following information. First of all, the date of the transaction. You can't tell a story without telling when it happened. The second bit of information that's very important is the source document reference number. So that might be the invoice number at the top of the page. It might be the receipt number on the receipt. It can be really anything that tells you which document you're referring to when you record the transaction. You'll also want to make sure that you record how the invoice was paid or how that receipt was paid for. Did you pay it by cash? Did you pay it with the company credit card? Did you pay it with the company debit card? Maybe you paid for it with your own personal debit card, and therefore your company will need to reimburse you for that. So be sure to record how that transaction was paid. How did your customer pay you? Did they pay you in cash? Did they pay you by check? Did they send you an e-transfer? Make sure you record how that money came in. All of this information is going to make it so much easier for you to track and to trace if you're ever asked for that down the road. It's also a good idea to put a brief description of what that transaction was for. Often people will think that they will remember what it was. Well, we went to Canadian Tire and we bought stuff. Well, what stuff? Sometimes the receipts aren't all that clear as to what the item was that was purchased. And honestly, down the road, you will not remember what that was for. Make sure that you include then the name of the customer or the supplier. Be sure that you keep all those source documents that show the details of the transactions. And when you look at that source document, if it's not perfectly clear what it was that was purchased or sold and what it was that was happening in that transaction, make a few notes. Flip that receipt over and just jot down a few notes of what was purchased. Canadian Tire is one that comes to mind. It's very difficult sometimes to look at a Canadian Tire receipt and know for sure what those items were that was purchased. because of the shortcuts and the abbreviations that they use in their system. So flip it over and write out what it was that you bought and what was the purpose for your business. If by chance or by bad luck you have a CRA audit by the Canada Revenue Agency, they may go back years to have a look at your records. And if they pull out a Canadian Tire receipt or any type of receipt and ask you what this was for and for what purpose was it used in the business, 5 years ago, you probably won't remember. So go ahead and write some notes on the backs of those receipts. It really will just help you in the end. So it's always important to remember in the back of your mind as you're going through each of these transactions that your goal in all of this is to record the transactions on a daily basis, to track your revenue, to track your expenses, to keep track of what you owe for your loans, to keep track of what you owe the government for GST and payroll. So the more information you can provide on those transactions, the easier it's going to be for you to track that. So let's talk a little bit about recording sales transactions. Those are the most fun ones, aren't they? They're the ones that mean money is coming into your business. So sales or revenue is recorded as a credit to the appropriate revenue account, okay, for the portion of the sale only. So you may choose to break down your sales into different categories, and that's all going to depend on what you as the business owner wants to be able to see when you do a review of your records and your bookkeeping financial information. Do you want to see how much of your sales revenue came from sales of product? And do you want to see how much of your revenue came from services that you provide? So for example, if you own, say, a music shop or a guitar shop, you might want to know how much of your sales in the year came from actually selling those guitars versus how much of your sales came from teaching guitar lessons. Okay? So you can break those down into as many different categories as you like. Just remember that when you record that sale, you're going to record just the sale portion alone, not the GST, just the sale portion into the appropriate category in the credit column. The GST collected will also be a credit, but that will be recorded to an account called GST on sales in your general ledger. So as we discussed before, and we talked about the importance of keeping your books in balance, every time you record a credit, you must also record a debit. So if the sales went into the credit column, then the debit column is the total amount of that sale, and you need to show where that money went. So you made money in the sale of your guitar lesson. Where did the money go? Did it go into the bank? Does it go into an account that says cash to be deposited because it's sitting there waiting to go into the bank? Does it go directly to your credit card statement? Okay. So you need to record in the debit column where that money went to. If the sale was charged, the debit would be to the accounts receivable account. So if your customer charged it, you would debit accounts receivable, meaning you'll receive that from them later, and the credit would be to the sales. Just a quick note that if you are using accounts receivable, you need to also keep a subledger to the side that itemizes each one of your customers, how much they owe and how much they've paid, so that you can track throughout the year what the balance is that they still owe you. You'll also need to know what that total amount of accounts receivable is. That's an asset to your company, and it will need to be recorded in some of your financial statements down the road. So keeping a separate ledger for each customer and what they've charged with you and what they've paid to you, so that you can keep a running balance. So if we have a look at the bottom of the screen, there's a sample then of how this sales revenue transaction should be recorded. So the sale would be a credit for say $50, okay? And that goes in the credit column under your sales revenue in your general ledger. The GST has been broken out, so the sale is $50, but the GST is $2.50. And because it's a GST on the sale, it too needs to go in the credit column. But to balance it, then the total amount of that sale, $52.50, needs to go into the debit column. In this case, the money went directly into the bank, and so it becomes a debit to the bank account. The bank account is an asset, so we will debit that account. So that's sort of a general entry for entering a sale. Now let's look at what an entry for an expense would look like, or a purchase. So expenses, as we discussed earlier, are increased by putting them in the debit column. So you will record an expense in the debit column for the portion of the purchase only. So do not include the GST. The GST will be broken out and it will be put in as a debit to a GST paid on purchases account. Both of those are expenses. Well, the GST isn't really an expense, however, it's treated as an expense and it is debited. So just like in the previous transaction, we must keep our books in balance. So the amount that you put into the debit column must also be put into the credit column. If you have debited your expense, then you need to determine what to credit. So a credit for the total amount paid shows where the money came from. So you might credit your bank account, you might credit your credit card account. If you charge that purchase with your supplier, then the credit would need to go to your accounts payable account. And that is a liability. It shows you what you owe to that supplier still. It has not been paid yet. The expense is recorded, but it's showing that it still needs to be paid for. Just like with the accounts receivables, where you need to keep a detailed listing and accounting of what your customers owe, you should also keep a side subledger to show what your accounts payable are. So a ledger for each one of your suppliers, what you've charged to them and what you've paid to them, so that you can keep a running balance of what you owe each supplier. The total of those will be used on a financial statement to show what your total owe, what you owe totally to your customers, to your suppliers, sorry. So here's an example again at the bottom of the screen. This is an example of how to record rent, which is an expense to your company. If your rent is $500 plus GST, then the rent expense in the general ledger would have $500 recorded in the debit column. The GST on that rent would also be in the debit column of $25, 5%. So the total of that transaction, $525, whether it be written by a check, an e-transfer to your landlord, paid in cash, but it came out of the bank, then becomes a credit to the bank. So that's the basic way to record now a sales transaction and an expense transaction. Basically, it's recording the money in and out. Some of the other entries that you will find yourself having to make when you're doing your daily transactions are sometimes neither a sale nor an expense. For example, you might have to record a loan payment. You see on your bank statement that you've made a loan payment of $750, but it's not an expense, so you can't put it in any of those accounts. It's not a sale, so of course you can't put it in the sales account. So where are you going to put it? Well, if you have created a loan account, which is a liability in your general ledger, then you need to treat that transaction as though you are reducing the liability that you have. If you have a loan for $5,000 and you're making a $750 payment, you are reducing how much you owe. So to reduce a liability, that amount needs to go into the debit column. So if your payment was $750 and you have a look at the example there, $750 goes into the debit column for the loan account, and it goes into the credit column because it's coming out of the bank. Anything that comes out of the bank is a credit, therefore it's recorded in the credit column of the general ledger. That's where a lot of people will make a common error, is trying to understand the debits and credits of the transactions that are going in and out of the bank. When you look at your bank statement, disregard the debit and the credit at the top column of your bank statement, because that is the exact opposite of the way you need to record it in your system. Think of a credit to the bank. If you were the banker, a credit to their customer, or to you, the customer, means that's a liability to the bank, right? So if you have $5,000 in your bank account, that's an asset to you, so that's in your debit column. But to them, that's a liability. So they record it as a credit on your bank statement. And that's where there's a big confusion often with people that are trying to do their own bookkeeping. Your debits and credits are not the same as the debits and credits on the bank statement. So we recommend taking your bank statement, crossing out debit and credit at the top, and rewriting it. Change the debit column to credit, the credit column to debit, and that will help you make the transfer into your recording general ledgers easier. So similar transactions to this one might be things like making a credit card payment. So you're reducing what you owe to the credit card. You're going to put that as a debit, and you're also reducing what comes out of the bank, because you're taking that cash to make a payment to your credit card. So therefore, again, a debit to your credit card account and a credit to your bank account. Also something like a payroll remittance, where the money is coming out of the bank to pay off the liability that you owe to the government for your payroll expenses and liabilities. Payments that are made to an accounts payable. So if you charge that item for $50 that we talked about in the previous slide, and now you want to pay for it, it's coming out of the bank. So you will credit your bank, but debit the accounts payable, because now you're reducing how much you owe. Makes sense, doesn't it? No. I get it. It's confusing. It's just something that takes a little bit of practice, and sometimes you'll need to stop and think each transaction through. So to help you do that, we've created a cheat sheet. And so this is something you may want to print off, something you may want to keep next to your computer or on your desk when you're entering those transactions. And it's just a little guide that helps you to remember how to increase and decrease the different accounts, whether you're going to use a debit or a credit to do that. And all of the different types of accounts have a normal balance. So what should those balances be for the different accounts? Should it be should an asset be a debit, or should it be a credit? So this is going to help you kind of keep that straight. If we look at all of the different account types, let's have a look at assets first. So assets we know now are the bank accounts and maybe our accounts receivable. The normal balance for those accounts should be a debit. You want your bank account to be in a debit balance. That means that you have money in the bank. If it's sitting in a credit balance, it means you're in your overdraft. And so the normal balance that you want your bank to be in is a debit balance. So in order then to increase that balance, we'll need to continue adding debits. If the normal balance is a debit, you'll continue to increase by putting in more debits. If you need to decrease that balance, so when you take money out of the bank, then you will put that in credit, because in order to decrease the debit balance, you'll need to do the opposite and record the credit. Okay, so that's the first line. The normal balance should be debit. You'll increase it with the debit. You'll decrease it with a credit. Liability accounts are the opposite, okay, and they normally have a credit balance. That is the credit or the amounts that you owe to people, whether it be your bank or your suppliers. So if it's normally in a credit balance, in order to increase that credit balance, then you're going to put those amounts in the credit column. That's going to increase what you owe. But if you're making a payment to those liabilities and decreasing what you owe, then you'll need to do the opposite and put it in the debit column. Okay, the next one is for equity. You'll see again that it's the same as a liability. Its normal balance is credit, so to increase and decrease is the same. Your revenue and expenses, revenue should be a credit balance. The more revenue you have, the higher the credit balance. So when you're increasing your sales and recording sales, you will increase that by putting those amounts into your credit column. If you have some money that you've had to return to a customer and you're decreasing that sale, then you will put that in the debit column. Expenses are increased by using the debit column because their normal balance is a debit. So the higher that debit column is, the higher that expense is. So to increase those expenses, you'll record them in the debit. If you took back something that you've purchased and your expense has gone down, then you will credit that amount. So just a little note on the bottom there that the GST on sales normal balance is just like the revenue account. So the normal balance for GST on sales should be a credit. And on the flip side, the GST on purchases normal balance then should be a debit, the same as your expenses. So again, this is just a little cheat sheet to help you remember debits and credits. What should it increase? What should it decrease? And it's something you'll probably want to keep handy when you're doing your transactions. The next thing we're going to discuss is your bank reconciliation. So in your general ledger, you've been diligently recording every day or every week, whenever you sit down to do your bookkeeping and your records, is tracking what happens through your bank account, pardon me. So what's really important for you to do as a business owner that's doing your own bookkeeping is to do a monthly bank reconciliation. Reconciliation simply means to balance and to match. Make sure that they say the same thing. And to do the bank reconciliation, it really is just a process of matching the transactions that you have in your bookkeeping records in your general ledger to the bank statement and making sure that all of the transactions correspond and that the balances at the end of the month are the same. It verifies that all of the transactions you've recorded in your account system, whether that be a handwritten general ledger or whether that be an accounting software such as Sage, that what that system says is in your bank is what the bank statement says is in your bank. Because if they don't match, there's been an error somewhere. Either there's something missed in your records, or perhaps there was an error on the bank side that they didn't record either. Doesn't happen very often, but it definitely does. Also, there may be things that have happened in the bank that you had forgotten about and forgot to record in your general ledger. And so by doing this bank reconciliation, you're going to verify that everything that happened in that month is recorded in your system as well. So you're just going to be tracking and matching all of the transactions of money going in and out of that bank account. We strongly encourage you to do them on a monthly basis for both your bank accounts and your credit cards. Often think of your credit card as, a bank account as well. Money is going into it when you make a payment, and it's coming out of it when you make a purchase. And it's something that you want to record on a monthly basis and verify on a monthly basis to make sure that everything is correct. Some of the common items that are missed in your accounting records or your bookkeeping records that make it extremely important are things like bank charges. So bank charges are not something you will have a receipt for that you will have sat at your desk and recorded when you were recording all of the other receipts. Nor will you remember to record the bank interest, how much maybe that you made on your savings account, or things like your regular payments that maybe once a year come out of your bank account that you don't have a monthly receipt for, and you may have inadvertently missed recording it in the month that that annual payment came out. So you'll see those items on your bank statement, and if you don't sit down to do a reconciliation of that statement, those are charges or interest or revenue that you are completely forgetting and missing in your records, and they're very important. So there are 7 steps that you can follow to create your bank reconciliation. Again, something that you might want to do or should probably do on a monthly basis. The first step is to do a comparison. So you're going to compare your bank statement to the general ledger bank account that you have in your records, whether that be on your Sage program or whether that's your handwritten general ledger. And you're going to check off all of the items that match. So for every transaction where money went out of the bank, you're going to check those off on both the bank statement and in your general ledger. Same with all of the deposits that were made. You're going to check those off to make sure that that transaction is recorded in both places, both in the bank statement and in your general ledger. Once you've done all that, Then you're going to need to add the deposits to the bank statement balance that you have recorded in your general ledger, but maybe haven't shown up in the bank account. So for example, you may have made a deposit on May 31st at 4 o'clock at the bank. And when you sat down at the end of May to record all of your transactions, you recorded that deposit in your general ledger. But when you got your bank statement, you don't see that deposit because it may not show up until the June 1st or the June 2nd even line of the June bank statement. So in order to do this reconciliation, you're going to need to take that outstanding deposit and add it to the bank balance on this statement, on the bank statement. On the other side, you're also going to need to deduct from that balance on the bank statement any outstanding checks that you have written and recorded in your general ledger that maybe haven't cleared the bank yet. So for example, you might have written a payroll check to your employees on May 31st, but those checks aren't going to clear the bank and show up on that May bank statement. They're not going to show up until June. So then after you've added the deposits that didn't show up, you're going to subtract any checks you've written that haven't shown up yet. Okay, then you're going to add or deduct any bank errors. So when you were comparing back and forth, you may have seen that the bank made an error and maybe there was a few cents out, or maybe there was something that happened that wasn't correct according to your records. So whatever that error is, whether it was an addition or a subtraction error in the balance, you need to correct that and add or subtract it to the balance of your bank statement. Okay. Then in your general ledger, you'll need to record things like bank service fees. So on your bank statement, you will see fees that your bank charged you. It might be the monthly fee that they charge you just for that type of account. It could be a fee that they charge for a transfer between accounts, perhaps an e-transfer charge of $1.50 or something like that that you've sent away or that's been received, any ATM fees. So you'll need to add all of the bank charges that the bank added to the withdrawals in your account and enter that into your general ledger. Also, there may be bank interest. If you have an interest earning bank account, you'll see that the bank adds at the end of the month any interest that you've earned on the balance. So that is something that hasn't been recorded in your general ledger yet, and you'll need to go ahead and do that. So that type of a transaction would be to debit the bank account and credit your interest revenue. So one of the revenue accounts that you'll want to create in your general ledger is interest revenue. Once you've got all of the transactions entered in both that may have been missed, so whether there was something missed in the bank or something missed in your general ledger, you've gone through both of those now, you've made the comparisons, you've entered them where they needed to be entered, then compare those statements again, and those bank balances should match. If they don't, that means that there needs to be an adjustment made either in your general ledger or something that you need to discuss with your bank if there was an error made there, because they need to match and balance to be sure that you have recorded everything in your records that are equal to the transactions that have actually happened in your account. So you can see why that's important to be done on a monthly basis. If there was, for example, a withdrawal from your bank account that you aren't sure what it's for, but you're not doing this bank reconciliation until the end of the year in December, it's going to be very difficult for you or your bank to make any corrections on a transaction that you probably don't remember from 6 months ago. So again, we stress very, very much that you should do this on a monthly basis as quickly as you can after receiving that bank statement. So once you have balanced your bank and you know that everything that you need to has been entered into the general ledger, then you can start taking that information and summarizing it into different kinds of financial statements. So once all of those monthly transactions are entered, you have then created your general ledger that we talked about at the beginning. And that data that's in the ledger is used to produce all types of statements that will help you understand your business from a variety of perspectives. The first one that we recommend that you try to do on a monthly basis after you do your bank reconciliation is the trial balance. And to create a trial balance, you're going to record the list of all the accounts in your general ledger. So you don't need to categorize them into assets or liabilities or anything like that. You're simply just going to write down all of the accounts in your general ledger and record the ending balance at that time. So if you're doing it at the end of the month, what was the running total balance of each one of those accounts? And you're going to want to record those in the appropriate columns, whether that's in the debit or the credit column. So your asset accounts will have a debit balance, your liabilities in the credit column. And once you're finished listing them all and listing their balance, you'll sort of total up each one of the columns. Your goal when you're creating that trial balance is that the debits must equal the credits. If after you've listed them all and you've totaled them up and those two numbers at the bottom do not match, then you know that you have missed one side of your transaction. So you may have recorded the transaction into the bank, but maybe didn't record it as a sales on the credit side. So that's going to make sure that you have done everything correctly and that your books are what we say to be in balance. So here's an example of Paul's Guitar Shop, and he created a trial balance to the end of his year. Perhaps it's December and he's doing one for the end of the month or for the entire year. So you'll see his list of accounts there. He has cash, accounts receivable, his inventory, his payables, and all the liability accounts that he owes, long-term liabilities such as his bank loans. He's also recorded all his revenue, so all of the sales he's had in that period, all of the expenses that he incurred in that period, and he's put them in the appropriate columns, debit or credit, based on the running balance throughout the year or the month or whatever that time period was. So you'll see then at the bottom that $186,300 was in the debit column, and that same amount was also in the credit column. So that tells Paul of Paul's Guitar Shop that all of his transactions were recorded correctly and that they were recorded evenly and in balance. So from there, he can move forward to create his next financial statements knowing that everything was entered accurately. So the next financial statement, and this is probably the one that will be of the most importance to you as a small business owner on a regular basis, is an income statement. Sometimes you'll hear that referred to as a profit and loss statement. And this is one that you can prepare on a monthly basis, maybe a quarterly basis, and definitely on a yearly basis. However, we don't recommend that you wait for a whole year to prepare yourself an income statement, because what this statement is going to show you is whether you are actually making a profit or not. And quite frankly, that's the whole reason you're in business, right? So you really need to know on a monthly basis whether it's what you're doing is working or whether it's not. It's also going to help you see a trend in your business. You'll be able to look back on income statements that you've prepared in the past and maybe realize that June is a month of low revenue. So what can we do in the month of June to reduce some expenses in that month and help us with our bottom line in that month? Or it will help you prepare for the month of June in the previous months, knowing that in the past, June has always been a month perhaps where you've incurred a loss. So by having this financial statement, it's really going to help you make some decisions, help you be prepared for certain times of year, and help you analyze what's working and what's not. So to prepare an income statement, you're needing to record all of the revenue accounts. So if you've broken your revenue down into, for example, Paul's Guitar Shop broke his revenue down to sales based on guitar lessons and sales based on the merchandise that he sold. So you'll record all of those different revenues, even including your interest revenue from the bank. You'll record them, you'll record their balance, and you'll total it up to find out what the total revenue was for that period. Let's say for the month. After you've done that, then you need to record all of your expenses for the month. So you may have your rent expense and any merchandise that you purchased for inventory. You might have your telephone bill, your advertising bill. Total up all of those expenses, list them and total them so that you can find out what your total expenses and costs were for the month. Once you have those recorded, you can subtract the revenue you made and the expenses that you paid out. So revenue minus your expenses will give you the bottom line. And you quite often hear business owners talking about what was your bottom line, or what is my bottom line, or that will affect my bottom line. This is where the bottom line comes from, is the income statement. If your revenue, of course, is higher than your expenses, you have a profit. If your revenue is lower than your expenses, you have a loss. And now you have a tool to look at to determine why that loss occurred. Was it the revenue was low? Was it the expenses were too high? And that sort of thing. So revenue minus expenses equals your profit and your loss. So here's Paul's Guitar Shop again, and an example of his income statement for December 31st. So he's listed his revenues, his merchandise, his guitar lessons, and his total revenues of $27,800. He also listed all of his expenses, so his cost of goods sold, which is typically purchases made that add to his inventory, or any expenses that incurred that are a cost to do business. Okay, he's also included things like his wages, his rent, the interest that he had to pay on the loans or to the bank, the supplies, his utilities, all of those things. He's listed them all, he's totaled them all, and he's come up with a total expense of $14,850. So if we take his revenue of $27,800 minus his expenses of $14,850, we can see that Paul made a total profit, or a net income, of $12,950. So this gives him a really clear picture of, were those sales the same as they were last year at that time? Were they higher? Were they lower? And why? Maybe have his expenses gone up? Or did he do a good job of cutting back on his expenses? Because this gives him a picture of what happened, revenue and expense-wise. Okay, so the next financial statement is one that is equally important to being able to determine the health of your business. However, it's not necessarily as useful to you on a monthly basis. This is the balance sheet, and it gives an overall picture of the business health at a specific date and time. So, for example, your year-end date. Whereas the income statement can give you that information in a range. You might choose to do an income statement from January 1st to March 31st. A balance sheet is just on one specific day. So it's for the entire year of business up to this particular date. So it could be up to May 31st of 2018. How are we doing to this point in time? What the balance sheet shows is all of the resources that your business owns. So your assets, being your cash in the bank, your investments that you've made, the equipment that you own, the receivables that are about to be coming to you. Those are all your assets. So it shows what you have in that respect versus what you owe in your liabilities. How are those assets financed? Do you have all of these assets, like all of this equipment, but it's all financed through the bank? And how much of it is still owing? How much of it do you still need to pay? That's why the bank loans manager will quite often ask to see your company up-to-date balance sheet if you're going in to apply for a loan. What they want to see is, what does your business own? What assets do you have? And conversely, what liabilities do you have? How much do you owe? And how are those assets able to pay off the liabilities you already have? So will your banker be able to provide you with more loans? If they see on your balance sheet that you own a lot of things and you don't owe a lot of money, then you're quite free to be able to take on more debt. If your debt is quite high in comparison to the assets that you own, then your bank manager is going to be able to determine whether you qualify for that loan. So again, this is a really good tool to determine the health of your business, but it's not one that you likely will need to prepare on a monthly basis like you do your income statement. But you should know how it's done and what's recorded in those, so that you can do that if you're asked for one partway through the year. And so to do that, you're going to record all of your asset accounts and their balances as of that specific date. So if you choose May 31st to be the date, then you're going to record all of your assets accounts to that date. So your bank balance to May 31st. Record the total assets by adding them all together. and then record all of the liabilities accounts and their balances to that same date and add them together. So now you have your total assets and your total liabilities, what you own, what you owe. Also record all of your equity accounts and what that total is. So your equity accounts will include things like how much did you as the shareholder invest in the company this year? How much did you withdraw from the company this year in the form of dividends perhaps? And what were the retained earnings from prior years that have been carried forward in your business? When you have completed that, to be sure that you've done it correctly, the total assets should equal the total liabilities plus the total equity. So if those don't match, you've made an error somewhere. So here's an example for Paul's guitar shop. He's listed his current assets. Those are things that are readily available to him right now. So things like his cash, the accounts receivable, which is the amount of money that's going to be coming in from his customers. Prepaid rent, perhaps, is something that's an asset to him. It's something that's already been prepaid. He doesn't have to worry about it anymore. It's already done. The inventory he holds are his assets. They belong to him. Long-term assets are things like the equipment that you own, or the building that you own, or the improvements that you've done to the building, because those are things that kind of depreciate over time, so they're long-term. Okay. So he sees his total current assets, his total long-term assets, for a total of $172,900. Then Paul listed his liabilities. So his current liabilities are things that are kind of happening on a yearly basis, monthly basis, things like his accounts payable. How much does he owe to his suppliers? How much does he still have out there in unearned revenue? For example, maybe he sold a bunch of gift certificates and there's going to be people coming in to use those. Those are a liability to him and he needs to keep track of that. Then there's his long-term liabilities, things like bank loans. Those are things that are going to be paid off over time. So he owes, for example, $99,000 in bank loans. So he's going to total all those liabilities for a total of $149,950. He's also going to include the equity that he has in his business. So he's going to take the retained earnings for this current period, and in that case, those earnings come from the income statement that he just prepared. So we know that he made a profit of $12,950. So those are the retained earnings that are going to be added to the equity of his business. And that amount's going to transfer over to the next year, and the next year, and the next year, and it's going to just continue to add up. So he's going to record those retained earnings and also any shares or stocks that the company owns, or that how many shareholders or shares that they've sold in their business. When he adds that, $22,950, to his total liabilities, then that total equals $172,900, which is the same as his total assets. So assets equals liabilities plus equity. So his balance sheet balances, and he knows that everything's been recorded. And he can see then from this statement what he owns and versus what he owes. Is his business going to be able to pay off the debt they have? Does he own enough to cover the debt that he has? So those are the basic financial statements that a business will use on a regular basis. Your accountant at year end will provide things like cash flow statements and things like that that will also help you in making some decisions when you're meeting with that person and trying to come up with some strategies for your coming year. We just wanted to take a few minutes to discuss some of the common errors that we see when we take over a person's bookkeeping. Quite often, if a business owner finds they've become too busy and they bring our books to us, or they can't make things balance and they don't know why, these are some of the things we see that are usually the general common errors. The biggest one tends to be the subledger accounts for things like accounts payable and accounts receivable. So just like we talked about earlier, where if you're going to record something in your general ledger to the accounts payable account, you need to keep a subledger of who it is that you pay. Your accounts payable in the general ledger is just a summary of what you owe to your suppliers, whereas the subledgers are detailed. So if you owe the Mountaineer for publishing, and you owe the UFA for your fuel, and you owe Jiffy Lube for your repairs, and you haven't paid them yet, those are your accounts payable. But you need to keep a separate running total for each one of those. So you'll have a general ledger with UFA at the top, and you'll record things like the date and how much you charged on that date. And you'll keep doing that and doing a running total of how much you owe. When you make a payment, you'll record that payment and subtract it from how much you owe to keep that running total. And that running total for UFA, for the Mountaineer, for all of the different payables that you have should equal the total of the accounts payable that you have in your general ledger. And so quite often we see that someone will have recorded it into the accounts payable or receivable of the ledger, but they won't have kept track of it on a sub-ledger, and therefore they don't match. And so you're not really sure which number is the correct number. Other common errors are payroll entries, and sometimes those entries can be a bit complicated. There is CPP and EI payable, there's CPP and EI expense, federal tax payable, wages and salaries, vacation payable. So there are a lot of different areas, and there are a lot of different accounts that need to be posted to when creating just one payroll check. And those quite often have a lot of mistakes in them as well. So you'll want to be sure that you know and get some help if you're not sure how to make those entries to figure out what accounts need to be accounted for with each paycheck. Other errors include GST entries. Quite often it's usually because GST has been claimed or written down for something that really isn't even a business expense. And so something that may be recorded as just a withdrawal from a shareholder and not recorded as a business expense still has the GST broken out. And if it's not a business expense, GST cannot be claimed. And so we see those errors all the time. But on the other side, sometimes people don't break out the GST when they should be, and they're missing out on the ability to claim back some of that GST because they haven't made that entry into the specific GST account. Other times we see where GST is maybe entered late after the GST return is filed, but it's not captured and added to the next GST return. So for example, someone might have filed their GST return to March 31st. Then they sat down at the end of April to do their books, and they realized there were some cash receipts that they, as the business owner, paid for some certain expenses, and they should have been able to claim the GST on that. But that happened back in March. So although the GST return has already been filed for that period, and they're recording it into their records now, they're not remembering to add that to the GST that they're claiming for the next quarter. So often there's GST that has been missed that we need to try to help them clean up and figure out what they owe and what they don't owe. So always make sure that you're keeping track of the GST and that you're not forgetting to record it in the appropriate periods in which it happened. Other errors are things like bank entries are not posted correctly, or they're completely missed altogether. So when we talked about doing our bank reconciliations, that's where you're going to be checking to make sure that none of these happen. So we will have seen in some people's records that they haven't done their bank reconciliations, therefore they've completely missed a whole year's worth of bank charges that they could have been claiming as an eligible expense. Or on the other side is that they haven't been recording any interest that they've earned, and therefore they're not reporting all of the revenue that they have actually received. So again, making sure you do those monthly procedures to make sure and to verify that everything that's happened in that month has really been recorded. Another error is when customers or clients record their loan payments and they're not splitting out the interest and the capital. So unless you're lucky enough to have a loan that has 0% interest, every payment that you make for a loan to your bank includes a capital portion and it includes an interest portion. And you need to be recording what interest on long-term debt is a part of that transaction, because that is an expense that you can claim against your income. Okay? That, and if you are recording the entire payment to your loan account, that's not going to match your loan statement at the end of the year, because your loan statement is only going to show the balance of the capital. And if you've also been recording the interest portion to that, then your statement for your loan is not going to match your general ledger at year end. So be sure to take the interest out when you're making that entry. Of course, anybody working with numbers or anything that you do working with numbers, addition errors are always possible. So always just double check. Again, things like bank reconciliations, financial statements like the trial balance are going to be good safeguards for you to make sure that you haven't made those addition errors, because if those things aren't in balance and not in check, then you're going to know that errors have been made and you'll go looking for them. Incorrect dates is another big one. People often say, well, I can't get my bank reconciliation to match. And that might be because, for example, they've entered something into their general ledger on June 1st that really happened on May 31st. So their bank statement shows it happening in May, but you don't have it in your general ledger until June. So make sure you have the dates correct, and that's going to alleviate a lot of confusion. So I think that's sort of wrapped up everything that we wanted to talk to you today about in our Bookkeeping Basics webinar. If you found that this was helpful, wonderful. If you are feeling totally overwhelmed and still not sure what to do next or how to even get yourself set up, or maybe you're feeling like you just don't want to even tackle this project, then please feel free to give us a call. We're there to help you, and my team and I are willing to help whenever we can. So there's my number, my email address if you'd like to contact us. If you were happy with what you saw today, you're feeling confident and you're ready to move forward, then please be sure to watch for things like GST Basics and Payroll Basics that are webinars coming up. They will give you more detail on those two topics. That'll help you make those transactions and record those returns a little bit better and make sure you're on the right track there as well. We know bookkeeping can be a boring topic and that sometimes it's very overwhelming, and we hope we've done a little something to help take some of that away.